Good morning, ladies and gentlemen. Welcome to CapitaLand's webcast. Today, we bring you the key highlights of the circulars on the proposed restructuring of CapitaLand, which we released over the weekend. All information and resources on this, including electronic methods to submit your proxy forms, are also available at our shareholder meetings platform. You can find them via our CapitaLand website, or you can scan QR, which is on your screens now. We know it's a lot of information to plow through, and therefore we thought it's a good idea to invite our Group CEO, Mr. Lee Chee Koon, as well as our Group CFO, Mr. Andrew Lim, to provide you with an overview on the latest release. We have also invited analysts from the south side, as well as members of the media, to join us after the presentation for Q&A. And without further ado, I will first invite Chee Koon to address everyone.
Morning, everyone. Thank you for making time. Even though we have been doing this meetings virtually since the start of COVID, I must admit that I still prefer to have had the chance to meet all of you physically in a big auditorium to go through all this. I mean, I prefer the eye contact, at least to know who I'm at least speaking to. But anyway, it's been about 4 months since we had announced the proposed restructuring of CapitaLand. Essentially, that involves the privatization of the development business while keeping the asset management piece of the CapitaLand continue to be listed, which comprises the REITs, the stakes in the private equity funds, our lodging business, and of course our managers. Over the last few months, the team has worked extremely hard, not just to continue to manage the fallout from COVID-19 in different markets, also to continue to run the business, to prepare the restructuring, to brief the various colleagues, get down into the organizational details. I must also say that the team has worked extremely hard with the help of the advisors and the lawyers to get all the restructuring ready. And I'm happy to say that the circulars for both the scheme meeting and also for the listing documents have all been just uploaded. Before I proceed, I thought useful to just reiterate or to remind everybody why we are doing this restructuring. I think we have explained earlier that CapitaLand has been trading at the range of about 20 to 25% discount to NAV in the last 20 years, and that's not very, very different from the other developers in the region. But the key difference that I believe CapitaLand has as compared to some of the other developers is that we have built up a substantive asset management business anchored very strongly by our REITs. And the reason why we are proposing to go ahead with this restructuring is to allow our shareholders to be able to unlock value in the short term through the privatization of the development business, while continuing to be able to enjoy the upside, which we believe if we well manage the investment management business, they can actually trade quite strongly above the NAV. So we have included more financials and details in the documents. The key point that I just want to bring your attention to is really the views from IFA, our IFA, which is Evercore, that the consideration for the privatization of the development business, at least their view is that is fair and a reasonable one for all shareholders. Andrew will go through the details in the presentation later. And before I end the short briefing, at least on my end, I just want to reiterate that the proposed restructuring is really the first step. We have a long way to go to get us to where we want to be, but I hope that at least the actions over the last few months, or over the last few years, that the leadership team has been undertaking whether it is to get a new fund management license, renminbi fund management license in China, to recycle our Raffles City portfolio, bringing a longer-term capital partners, launching the logistics fund, growing our lodging platform, and continue to strengthen the various REITs platform, is a testament of what is to come. Over the next few months, the priority is to really get the restructuring done, continue to execute on our strategies, and also we hope to be able to bring in more experienced colleagues in the fund management space that can help us to strengthen our team and to focus on the execution. So that's all I have for my briefing, and I'll pass on the mic to Andrew, who will go through more details in the presentation deck. Thank you.
Thanks, Chee Koon. Good morning, ladies and gentlemen. Thank you for joining us on this Monday morning. I'll take you through a couple of key sections. There are three main sections in my 20-minute or so presentation today. The first section will be a quick revisit on the key rationale for undertaking this very important exercise for CapitaLand. My following section will be to touch on, by way of introduction of CapitaLand Investment, what we believe are 5 key sustainable advantages of CapitaLand Investment. And the third and final section will be to walk you through what we believe will be our strategies going forward for our fund management, our lodging management, as well as our capital recycling. Please bear with me. So let's take a look at a quick recap of this exercise. And as Chee Koon mentioned, we believe this to be a logical and natural part of CapitaLand's 3.0 journey of transformation. We believe that the proposed restructuring is designed to sharpen our strategic focus and, in the process, unlock value for shareholders, both in the short term as well as the long term. The way we intend to do so and propose to do so is to separate that part of the business which we believe is not valued well by the public markets, namely the development business, and to privatize that. This part of the business tends to be capital intensive and therefore requires patient capital that thus far the public markets have not shown to provide. The part that we will list by introduction is our fund management and our lodging management business, alongside a healthy component of our real estate investments. This is a much more capital efficient business, one that we believe is scalable through the growth of FUM and FRE, and one that evidence suggests is valued more readily and more highly by the public markets. As we shared with you on the 22nd of March, the evidence, as you can see on the left-hand side of the chart, is quite clear. REIMs, or real estate investment managers, tend to be valued differently from developers. And here we have constructed a proxy set of both developers and REIMs, as well as CapitaLand's performance, both on a PNAV and a forward PE basis. You can see, first of all, that our REIMs do tend to trade higher on both a PNAV and a forward PE multiple. And CapitaLand has, as a hybrid, as we have been in the past, tend to trade somewhere in between. But we are not satisfied with this performance, and as Chee Koon mentioned, our chronic PNAV discount has hampered the growth of CapitaLand, despite the changes we have put in place as part of a 3.0 journey. And we believe that this is the next important step in order to fully realize the potential for CapitaLand by unlocking short and long-term value. On the right-hand side of the chart, you see that thus far the markets have responded positively to our proposed restructuring. As of Friday's close, which I believe was 381, the stock is up 15% on a pre-adjusted basis per dividend. If you include the 9 cents dividend that we paid out, that performance is better. And finally, to recap, for each shareholder of CapitaLand that owns one CapitaLand share, we propose to distribute and transact in the following basis. Each shareholder will receive 1 share of CLI for each share of CL that they currently own. They will also receive 95.1 cents in cash and 0.155 CICT units as part of the distribution. In cash terms, which is the left-hand bar, this adds up to 2.823 based on an NAV of CLI of 31st December 2020. The cash consideration is 95.1 cents, and the 0.155 CICT units translates to a cash consideration of 32.8 cents. If you add these three components up, you get to an implied consideration of $4.10 for each share of CL that you currently own. And again, if you compare that to the last trading date before we made the announcement, that represents a substantial upside of 24% and an upside of 28% based on a 10-year VWAP up to the last trading date. If you look at where the stock was trading, again, 381, that on Friday, we believe that this still represents embedded value for shareholders today. Let's turn to the second section, and I'd like to introduce CapitaLand Investment. If you look at this slide, again, this should be familiar to most of you. We are separating the business into two components, major components. One is the fee income related business, comprising our fund management platforms, our REITs and our private funds, as well as our lodging management platform. And again, I'll spend a bit of time on the logic of why we chose to combine these two fee income platforms into CLI. The second part of the business is our real estate investments, which comprise of our equity stakes in our listed funds, currently estimated at 7.7 billion of market cap, our carrying value in our unlisted funds at about 5.5 billion, and about 10.1 billion of AUM in investment properties that we want to monetize into FUM in the next 24 to 36 months. As Chikun mentioned, we also include now some pro forma financials for you to get a sense of how the business is shapes up. On an NAV basis, as of fiscal year 2020, we have a pro forma NAV of 15.1 billion, separated into 1.2 billion assigned to the fee income side of things, and about 13.9 billion assigned to the real estate investment side. On an adjusted EBITDA basis, namely a cash EBITDA basis, in 2020, we registered an EBITDA or cash EBITDA of 1.3 billion, about 300 million of which was attributable to the fee income related business and the remaining amount to the real estate investment side of things. Okay, I'd like to spend a bit of time on these 5 key competitive advantages for CLI. We believe that these advantages are, first of all, compelling. They are differentiating for CLI. And finally, we believe they are sustainable. First off, while we are global REIM, we are anchored in Asia, and we believe that is going to be an important differentiator going forward. We are offering investors a full stack of investment and operating capabilities by combining a fund manager, an asset manager, a property manager, as well as a lodging manager. This is a unique full stack platform and of fee income business that we are providing to investors. We have a proven track record of delivering fee, FRE and FUM growth, as well as growth in keys under the lodging platform, all of which are generating double-digit returns over the last 3 years. Despite the separation of the CapitaLand businesses, we will retain a very important and unique CapitaLand ecosystem, allowing both sides of the business to leverage off the unique capabilities of each other. And finally, CapitaLand Investment will bring an experienced leadership team that will enable CLI to hit the ground running on day one of listing. So CLI, on day one, I would like to first of all show you that this is a diversified business. And if you think back to 2019, when we introduced the combination with ASB as part of the 3.0 journey, this allowed us to recalibrate the exposure to our 3 or 4 core asset classes, introducing a substantial slice of new economy. And today, as you can see from the bottom row, we are a much more diversified and balanced business, whether you look at it from an REAUM basis or from a fee income FUM basis. I think this is part of the journey that we have undertaken since the start of 2019. But equally important, on the right-hand side of the slide, you see that based on the FUM and REAUM, 80% of our business is anchored in Asia. And we think this again is an important differentiator for CLI going forward. Why is this important? This is important because most of us, ourselves certainly, believe that Asia is going to be a key growth engine for FUM going forward. Most of the institutional investors that we speak to, most of the market practitioners that we are familiar with, have told us that they believe Asia to be a growth engine for capital as well as investment opportunities. And this puts CLI in an advantageous position based on the fact that our presence has been anchored in Asia thus far. We are bringing to bear a very unique value proposition, combining a fund and asset manager, 6 listed funds, over 20 unlisted funds, a proven track record of double-digit FUM growth, as well as asset management of over 330 commercial buildings and over 120,000 lodging keys already in the system, underpinned by a best-in-class operating platform, especially for our high-touch businesses such as retail and lodging, where you can really make a difference in the ability to operate an asset properly. This then translates into discrete fee income streams that you see on the right-hand side. And we've reproduced the 2020 fee incomes for our investment and asset management, our lodging management, as well as our property management. For those of you who have already had a look at the financials, this contributed about 40% of group revenue, or CLI's pro forma revenue for 2020. Some of you asked us on March 22nd when we first introduced CLI, why we put lodging management into CLI. And I thought it would be important to just revisit that as to why we believe that the two businesses actually exhibit very strong parallels. Both are global in nature or leading Asia-centric types of businesses. So we have a platform that we can extend and leverage off globally. Both employ a track record of being able to either diversify across sectors or diversify into adjacent sectors in the case of lodging management, such as PBSA and multifamily. And both have the ability to scale up rapidly. But what is most important, and the bottom of this slide, is to acknowledge that both of these generate recurring fee income that are built on scalable fee-generating AUM. This is the most important similarity between fund and lodging management. This makes them capital efficient and ROE accretive, and allows us to leverage off our existing global investor and partner network as we seek to grow both platforms. This is how this comes together. On the left-hand side, you see our FUM of 46 billion, growing to 78 billion by 2020. So this is our 5-year CAGR of 11%. On the right-hand side, we have our lodging business, starting out at 72,000 keys under management, growing at a 20% clip to 123,000 keys by the end of last year. Both of these types of businesses combine to generate fee income AUM for us. And we give you some financials below relating to the FRE FUM ratios, the types of income, the stable state income that we can generate, as well as the growth rates for both of these businesses. So you can see that as we characterize CLI first and foremost as a fee income business, it makes logical sense to combine both of these platforms, whose purpose is to generate stable, recurring, ROE accretive, capital efficient FRE. That FRE has been growing at a steady clip, as I mentioned earlier, and here again we are able to share with you for the first time some financials. Both for lodging management as well as our IAM and P management, we see that we have demonstrated a track record of growth, notwithstanding the fact that 2020 was a very challenging year for all businesses, ourselves included. Despite a soft ability to recycle capital, more challenged operating environment, particularly for our lodging business, we were able to demonstrate overall fee income growth for CLI. On the right-hand side, you see how that NAV of only 8% on the overall basis has translated into 40% of revenue and over 20% of EBITDA on an adjusted basis. This is our cash EBITDA again. Again, I point you to the challenging year that we experienced, particularly for the lodging management business, where we were unable to deliver a meaningful EBITDA for 2020. And that again, I think, goes back to where we are today and how we position CLI for growth and recovery. So here's where the ecosystem comes in. The interesting parts of the ecosystem are most notably the north of 7.6 billion of pipeline that is currently sitting on CLD's balance sheet that we have a first right of refusal to. So when these assets stabilize, then we will have an arm's length agreement or a discussion around converting that REAUM into FUM, which will earn fee income for CLI. That is the plan. We also have, as a co-development and co-investment partner, CLD, who has capital to also deploy into interesting development projects or funds that they may find interesting to co-invest alongside us. It's interesting to note that of the 20 or so private equity funds that are coming across to CLI or that we manage, there are actually currently 4 funds which are development or commercial development based in nature that are currently invested in by CLD. These are in China and in Vietnam, constituting almost 2 billion of our FUM. I think this is an interesting template that allows you to see how CLD can come on board potentially as a capital and investment partner, as well as potentially providing useful future pipeline for CLI. So overall, within this ecosystem, we are able to share talent, we're able to share capital, and we can share our core services with one another, obviously on an arm's length basis. And finally, we wanted to make sure that when we list, we bring to the market an experienced team that can hit the ground running. And as you can see across the fund management, the asset management, the operating platform, as well as core corporate functions such as innovation and sustainability, we have a dedicated and experienced senior management team in place to execute from day one. Okay, let me just wrap up by going to the third section, again, which is very important, and this talks about our strategy going forward. We have a fund management strategy, a lodging management strategy, and a key component of how we intend to deliver ROE, and that is obviously our capital recycling execution. This is a summary of our fund management strategy across 3 strategic growth areas, our sectors, our geographies, and the types of strategies that we employ. So you'll see that drills down into our core sectors, our new economy sector, our commercial integrated sector, and our lodging sector. We have key strategies in logistics, business parks, data centers, obviously our existing commercial integrated platform, and in lodging, expanding beyond traditional service residence into multifam and PBSA. Our core markets in Asia, Singapore, China, and India will be complemented by our focus markets, Australia, Japan, Korea, as well as complementing that with a meaningful presence in the developed markets outside of Asia, namely in Europe and the US. Traditionally, we have employed a core and core plus strategy in our fund and REIT product. We want to supplement that with more value-added as well as alternative and opportunistic strategies that we hope to be able to announce in the near future. We have established vehicles, obviously our REIT platform, over 20 private funds. And what we would like to also introduce is to more fee-earning types of JVs, strategic JVs, such as the one that you recently saw with Ping An. And obviously, this is going to be underpinned by a very unique, best-in-class operating platform, particularly for our retail and our lodging businesses. This is how it translates to in the near term. What we set out here are selected recent transactions that are occurring throughout CLI. If you add up the announced values, they actually total north of 9 billion that we have entered into, 3 billion of which are year to date, and the remaining 6 billion were announced 2 to 3 years ago, particularly in the commercial integrated space, for example, with Capita Spring and RCTB, but are turning operational in the near future. So we thought it was it was right to include them as well. So 9 billion plus already in announced value of how we intend to grow the business, 3 billion already year to date, particularly new economy and longer stay lodging. Of this 9 billion, we estimate that about 1 billion worth of that is actual CLI equity, which translates to a very efficient use of our equity going forward and should provide you with a template of how we intend to grow the business and our ability to scale FUM using an efficient level of CLI equity going forward. On the right-hand side, you see the project status. You can see the combination of existing FUM already in the case of an acquisition made by a REIT or a fund, or a pipeline opportunity where we have put an on-balance sheet investment, which we believe we can convert into FUM in the near future. On a geographic basis, you see that most of these are consistent with our 80% plus coverage of Asia and our desire to focus on Asia as our core geographic region. And from a strategy perspective, you see much more focus on things like opportunistic and value add, where we believe we can add additional FRE to what is already a very established core business for CLI. On the private side, I think most of you have pointed out that our business, I think the phrase I'll use is, has been steady but not spectacular, where we have on average incepted one new fund per year for the last 5 years. But what I'd like to leave with you is while we have sort of steadily grown the business, 2021 marks a shift in that focus, where we have been very busy already putting the pieces in place to execute on a much more focused strategy. Again, coming back from that sharpening of focus into the fund management business. We partially divested stakes or exited stakes in 2 private equity funds, Ascendas China Business Parks, as well as Raffles City. But it's important to note that we retained the FUM. So we converted our private equity stakes into REIT stakes. In the case of ACPB at CLCT, and in the case of RCCIV, we kept that through a strategic JV. So we are retaining FUM whilst converting our funds that are maturing. And this is again speaks to our ability to retain our FUM going forward and the desire to do so. In the process, we incepted 2 new funds, Korean Data Center Fund 2, building on the success of our Korean DC Fund 1, as well as recently announcing the second incarnation of our India Logistics Fund, again, building on the success of Logistics Fund 1. And finally, certainly not least, we announced that we have now are the recipient of an RMB fund manager license, which will really allow us to look for equity partners, capital partners inside of China. And we believe that, again, to be a key strategic differentiating advantage for CLI going forward. So I hope that this leaves you in no doubt that our private equity business is going to be a source of key focus for us, and we are already demonstrating the ability to execute on that growth plan. Turning to our REIT business, we are also not standing still, repositioning our REITs to take on the next lap, which will be continues to be strategically important for us. In the case of CLCT, ART, and CLMT, this involved mandate expansions to allow our REITs to become broader in the way that they approach their investments, particularly with CLCT and with CLMT. Now they are diversified country REITs, allowing them to tap into the full set of opportunities and pipeline that we are able to offer them in China and Malaysia, respectively. In the case where it made sense to recombine strategically to get larger and to build scale, we combined ART as well as with AHT into Asia's largest hospitality trust in 2019. And last year, we combined CMT and CCT into the largest S-REIT in Singapore, taking advantage of what we believe to be a strategic trend in integrated assets. And finally, our REITs have been taking on acquisitions-led growth into new subsectors, most notably in the case of DCs, where both AREIT and AIT have made substantial acquisitions, and in the case of AREIT have also diversified further with an maiden investment in US business parks. Overall, our REITs and BT's FUM grew at a 15% CAGR between 2015 to 2020, obviously helped by our combination with ASB, but even on an organic basis, we are confident that a 10% FUM growth can be maintained going forward. Let's turn to the lodging management strategy. And as I mentioned before, I think this is going to be underpinned by two key parts. The first is the ability to normalize our lodging platform as the hospitality sector moves into recovery mode. And we can go back to what was a much more normalized set of financials as more rooms become available and our operating platform returns to normal. The second part is where we like to deliver growth through scale. And here is where we have a target of 160,000 keys, 123,000 of which have already been committed, of which only 70,000 are currently operational. So there is a nice long runway of growth which will enable us to scale the platform further, allowing us to deliver additional EBITDA margin and EBITDAs into the bottom line of CLI. We will hope to do this through strategies such as further leveraging off our brand equity. The Ascott business is underpinned by several very key, well-known global brands, a direct distribution platform that seeks to marginalize the middleman and allow us to reach our direct customers much more readily through the internet, and obviously scaling up into technology, which is going to be a key driver of both growth as well as cost going forward. As I mentioned to you on the 22nd of March, we are already seeing that the service residence and long stay business is resilient compared to many other subsectors in the hospitality side. Last year, we signed a record number of 14,200 keys, which was an 80% year-on-year growth from the year before. And this was in a year where we saw the worst pandemic in the history of the world. We believe that this speaks to the resilience of this long stay platform, and we'd like to continue building on that resilience, and we are on track to match that growth in 2021. And finally, let's turn to capital recycling, where we continue to focus on a minimum of 3 billion in gross value per year for CLI going forward. We have demonstrated that ability to meet that target in the last 3 years. We have already surpassed that target this year. Much of this is due to several large divestments, most notably in Galaxis, as well as Raffles City. And again, this allows us to convert that into FUM going forward, which is a key driver of our strategy as part of CLI. Which leads me to my final slide, again, illustrating what the roadmap for CLI is going to be going forward. We are going to combine our organic growth of our fund and lodging management platforms, underpinned, as I mentioned, by our talent, by our track record of delivering FUM and FRE growth, and the fact that we have a unique platform of 3 notable and discrete fee income streams. We have CLI's pipeline of 10 billion plus REAUM that we will hope to monetize into FUM in the next 24 to 36 months, as well as an ROFR onto CLD's pipeline of 7.6 billion of REAUM. And we will aim to do this again with the ecosystem that we have in place and our track record of delivering on capital recycling. And finally, strategic acquisitions, where we have demonstrated our ability to execute on large transformational combinations, as you saw with Ascendus in 2019. Again, speaks to our execution track record, as well as our balance sheet, which, as you will have seen, is at a conservative 0.55 net debt to equity on a pro forma basis, which allows us circa 3 billion of dry powder if I take that net debt to equity up to 0.7. So if I combine our core key strategic advantages with our execution track record, our robust balance sheet and set of financials, we are very confident we can get to 100 billion FUM by 2024. We can deliver our lodging key growth to 160,000 by 2023. We can continue to improve our historical FRE to FUM. We can pay sustainable dividends in line with the best-in-class REIMs, and we can deliver a double-digit ROE in excess of our current cost of equity. All that remains is for me to give you some important dates before we turn to FAQ, apologize for taking perhaps more time than I should have. We have an EGM that is scheduled for Tuesday, the 10th of August at 2 p.m., where we will seek eligible shareholder support for this transformative restructuring. And if we get your support, we intend to complete the scheme and list CLI on or around Friday, the 17th of September. So thank you very much for your attention. For that, I will turn it back to Grace for Chee Koon and I to take you through some of your initial questions stemming from today's presentation. Thank you.
Thank you, Andrew. I would like to kick off the Q&A with analysts and the media who have joined us virtually. If you're watching us via webcast, you may also, we also welcome questions from you, and you may click the post question tab on your screens. And with that, I'll open the floor for questions. Analysts and media, please introduce yourself before you start speaking. And please, if you have more than one question, please let us have them one at a time. And I'll start with Terence from JPM.
Thank you so much, Grace, and thank you for the opportunity. This is Terence from JP Morgan. Congrats and thanks for the presentation, Chee Koon and Andrew. My first question is, what does CLI see going forward in terms of a successful 3-year growth path for perhaps in some of the numbers, the key numbers such as EPS growth, ROE, AUM growth, and asset recycling? Thank you.
Thanks, Terence. I'll take you back to my presentation. So I think the targets that we are able to share with you again speak to things like FUM of 100 billion, which we have previously announced, an ROE that we believe starts with a double-digit return. Obviously, that is going to be a journey, given that we are still in recovery mode. So bear with us as we drive ROE up from a very low base, given the difficulties in 2020. But I think you can agree that we have put in place the pieces to deliver an ROE that is sustainable and that is something that meets your expectations, given what CLI is set up to be on day one. It still involves a substantial balance sheet exposure, which is by design, giving us the ability to recycle capital, convert that into FUM. But as we explained on March the 22nd, having that acquisition headroom without the need to definitely call on equity of CLI, I think is a strategic asset rather than a liability for CLI business. So these are important pieces that we have put in place by design to allow CLI to grow. There is a trade-off in terms of obviously the equity base is going to be higher upfront, but we think that will pay dividends for us down the road, both metaphorically and hopefully literally as well. Hope that answers your question.
Thank you, Andrew. And I guess maybe following up from that, would you have a dividend policy going forward for CLI? That's my final question. Thank you.
Sure. The div policy is the same. It's still in the listing document. It states it's 30% of cash PATMI. Again, we've taken this decision as a means of continuing on something that was well understood, but does not necessarily mean that we can't revisit that in short order, depending on how we execute out of the gate. We have done well year to date, but I think if those of you who know us, CLI, we tend to take a more prudent approach in under promising and over delivering. So let's see where we are at the end of the year. If the recovery continues to allow us to deliver a good set of financial results, if we are able to continue to recycle capital, bring home net proceeds, deliver good portfolio gains and good cash EBITDA, then I think that leaves us in position to have a think about how we may revisit the dividend policy. But as of now, please accept it as a continuation of the 30%, no less than 30% of cash PATMI. Thanks.
Thanks, Andrew.
Next, we have Yu Kiang, CLSA.
Hi, Chee Koon. Hi, Andrew. Can you hear me?
Yep.
Yes.
Loud and clear.
Yeah, okay. My first question is, I'm not sure if I got it correctly. Do you still have a recycling target annual going forward? That's the first question. The second question is, out of the fee income of 770 and 786 from the 2019 and 2020, how much of this is relating to divestment and acquisition fees? And third question is on the China fund license. Can you elaborate? What are the opportunities that you see there? Should we expect this to be, some corporate action over there? Do you think that this will grow your China fund business to some kind of scale that we should expect? Thanks.
Thanks, Yu Kiang. Good questions. Let me take the first two and I'll turn it over to Chee Koon on the fund license, which is far more strategic than the numbers. Okay, so the divestment target, the recycling target, for now, I think we'll set it at 3 billion. If you think about the REAUM that we have at CLI, right? So 10 billion plus, and the target is to get this into FUM in the next 2 to 3 years. That translates roughly to 3 billion or so of gross value. So that's the big picture math behind why we chose to keep the 3 billion of recycling. Obviously, this doesn't include recycling that's happening at the REIT level as well. So that will be supplemented by whatever the REITs are up to in terms of regenerating and renewing their portfolios. Your second question was on fee income splits. Okay, that's a very good question. And it's helpful for me to share with you that in 2020, we had a very quiet year in terms of one-offs because the capital recycling was challenged by COVID. And so we made 3 billion, but it was not the year that we initially set out to achieve. So if I can leave with you that as a result of that, our fee income was much heavier split on terms of recurring base fees as opposed to typically what you would get from a contribution on a one-off basis. I would say that is close to maybe 10 to 15% coming from your one-offs and 85 to 90% coming from your recurring base. So again, I think there's good news there because if we get to a more normalized operating environment where we are recycling the way we hope to recycle, it allows us to supplement a very resilient recurring fee income base with more one-off fees coming from the capital recycling at the balance sheet level as well as the REIT and fund level. I will make one more point. Lodging last year was extremely challenged. So the fee income that you see from lodging, right, is also extremely compromised because of COVID-19 last year. If we get lodging up to anywhere resembling a normalized operating environment that gets us to a 69 million plus EBITDA level that we saw in 2019, that again is upside that comes purely from a normalization of business, not even a growth of the lodging platform before we get into scaling the lodging platform further. I hope that answers your question.
Can I just add that so 10 to 15% is the non-recurring fees, right?
Correct.
So given that you're still guiding for 3 billion recycling target and in addition that the lodging business is going to be relatively weak, should we still expect this kind of split for the next 2-3 years?
I'll leave that one to you, Yu Kiang. I think let's start with that as a base that goes up, right? Depending on how we execute. If this year's ability is any indication, then I would say that we should be able to deliver a more normalized one-off contribution going forward. But again, given the uncertainty in the markets going forward, the operating environment going forward, we would still caution.
Okay.
Yeah. Thanks. Maybe to Chee Koon.
Thanks, Andrew. Yu Kiang, thanks for the question on the renminbi fund management license in China. I mean, if you take a step back, CapitaLand has built up I would say, a pretty decent business platform in China. But traditionally, it has always been residential, integrated developments, retail. And it was only 2 years ago that we merged with Ascender Singbridge, and that gave us access to business parks, logistics, and data center capabilities. And I mean, in our transition to become more focused asset manager, I mean, we look at our business in China, we look at the potential. I mean, apart from the market itself, in terms of our investments, we have always used our balance sheet. We set up funds, but mainly offshore funds, to partner with us in terms of pursuing growth in China. And we believe that the domestic capital plays a very, very important role. So getting that license is important. I think the recent deal together with Ping An demonstrated our ability to work with a local player, and that deal, announcement of that deal, and also the fund management license, actually triggered a lot of reverse inquiries from the big players in China. I think the important thing is to make sure that we have the ability to source for good projects, be able to deliver good returns, be able to make sure that we can execute well. I think that the whole domestic capital that we can tap in China will be huge. And of course, we have a much bigger ambition apart from tapping Chinese capital just for the Chinese market. The big question is, are we able to tap on Chinese capital to go with us outside of China as well? So that's really the big question and the focus that we will be putting energy on as well.
Is there any targets, AUM that we should be expecting in a 3-year, 5-year target? Yeah.
Well, we have not made any announcement in terms of the targets, although I think the earlier press release, we did mention that we should look forward to at least the starting of first renminbi fund in China by the end of the year.
Okay, thanks. That's it from me.
Thanks, Yu Kiang. Next, we have David Lam, Daiwa.
Hi, good morning, everyone. Question on the fund management platform, in particular, its efficiency. How does 56% EBITDA margin compare against your global peers? Is the overhead platform of the platform too high? Are you top heavy? And roughly, what is the annual expense of the fund management business?
Hi, David. It's Andrew. I'll address what I can. I think the way you look at that is look at our equity stakes, which are currently quite diverse. And again, this is a function of the legacy of our PE business. So we currently have stakes of, I think, anywhere between 15 to 55%. The funds which have higher equity stakes tend to be our older, more legacy-driven funds. And that is something that, again, translates to your point about how efficient that capital is, particularly with the FRE, FUM ratios, and how much we are able to be more efficient going forward. So, again, I think this is something we look to rectify in setting up new product. The funds that we have been able to put together in recent history are much more capital efficient on that basis. The second point around our fee income ratios, again, is also, again, a function of where we have been historically and where we would like to be going forward. 56 basis points FRE to FUM is nothing to sneeze at, but again, it's not, 56% EBITDA margin is nothing to sneeze at, but it's something that we can certainly improve on in terms of being more efficient with our cost structures, as well as being able to leverage the talent and the ability of being on the ground in various markets. And again, this is where the ecosystem comes in. So it is, I would say, it is a good start. A lot of it is driven by our legacy, particularly on the PE side of things. And I think, as I mentioned in my final slide, it is going to be a focus for us to continue to improve the efficiency, both on an EBITDA margin basis and FRE, FUM basis as well.
Yeah, thanks for the clarification. And the final question is, why call it CLI now instead of CLIM? CLIM was easier to refer to. Anyway, yeah, thanks.
Thanks. There's no a specific reason. We look at the CapitaLand ecosystem. The development side is known as CLD. The investment side, we just call it CLI. I think the important thing is that the nature of the business, the focus remains unchanged, really in terms of growing the asset management part of the business. So it's more really looking at the naming from the entire ecosystem perspective.
Okay, thank you, David. We'll have Derek Tan, DBS.
Hi, good morning. Can you hear me?
Yes, we can, Derek.
Yeah, hi, good morning, Chikun and Andrew. I just two questions for me. My first question is on your target to grow FUM to 100 billion. Just wondering whether could you give us some color on potential like bolt-on acquisitions that you're considering, and would you look to expand beyond RE to say infra in the medium term? So that's my first question.
In terms of acquisition, I think apart from organic growth, I mean, deepening our own REITs, our private equity funds, I think that's something that we will continue to do. We will also look at originate new products. Of course, if there are interesting asset managers that could have a strategic fit with us, that's something that we can look at. But I just want to stress that we do not just want to grow AUM for AUM's sake. If we find partners that can help to increase our AUM, it must be something that could partners that should bring synergies to each other, so that when we put the two platforms together, it's going to be stronger as a system. Your question with regards to whether we're going to venture outside of real estate, I think we had started by moving into data centers. If there are indeed interesting opportunities where we can go venture beyond the real estate side, maybe to some parts of infrastructure, we may. But I think the important thing is to make sure that if we were to do that, we must make sure that we have the right team and the capabilities in place. Whether it's we build our own team or we work with other partners, we're not just going to do something totally out of the blue, going into new asset classes where we have no inherent abilities. So I hope that addresses your question.
Thank you, Chikun. So my next question is on, let's say, expertise in terms of, say, development in new asset classes. Just wondering whether at this point in time, if you look at the staff that's working under you, do you think that you need to employ more people? So to, let's say, as you venture to grow into the new asset classes like infra, data centers, or you believe that with the number of people that you have, it's sufficient already at this point?
No, we are definitely going to strengthen the team, especially on the fund management space, people with expertise in other asset classes as well, in other markets. I think some of the, if we can bring on board successfully some of the senior colleagues, you will see announcements as well. So that's really the key focus, because in the asset management business, apart from capital, I mean, the key differentiating factor is really the quality of the talent pool. Whether we have people who have the expertise, who have the ability to scout for off-market deals, to originate products, and of course a team that, I mean, a very important point in our is our belief in team members that can fit into the overall culture in an environment that's going to be increasingly competitive and complex. We really want to build a team that works well together.
Okay, thank you very much.
Thanks, Derek. Next, we'll have Louis Chua, CS.
Hello, morning, Chikun and Andrew. Two questions from me. I think the first is in relation to the first question that was asked in terms of ROE. I see that you have given the ROE more than cost of equity target. I was just wondering if you'll be able to share with us the target that the board or management team set for yourselves in terms of where ROEs are going to be based on your trajectory. That's the first question. And the second is in relation to the growth engine. I understand that you have a 3 billion recycling target, and based on what you have in the last slide, you have about 10 billion of CLI pipeline that can be recycled, 8 billion from CLD. But my question then is, after this 10 billion is being recycled through to your various platforms, and presumably whatever that is in CLD's pipeline can also go directly to some of the listed REITs as well. So where would CLI's growth actually come from that perspective?
Thanks, Louis. I'll take the question on ROE and turn it to Chikun on growth strategy. So I think if you go back to where we were in 2019, right? So CL delivered 10% ROE. as our current construct. And so if you believe that ROE is an important barometer of our ability to engineer return for shareholders, then I suppose the starting point in coming to shareholders to allow us to restructure and continue life as CLI should also include the belief that we can continue to deliver that type of ROE on a sustainable basis. I think that's one key reason where we believe that 10% at a minimum would be what our shareholders would come to expect from us. If we previously said that 10% SCL was something we could continue to deliver as a going concern. So I think that is one important component that went into the belief that sustainable double-digit ROE must be part of the equation for us to bring to our shareholders. Now, again, there are a couple of things that go into how we get there, when we get there, on a sustainable basis. The first is looking at CLI today, and I think this leads to your second question, it's a hybrid. It's not a pure REIM. It comes with a fairly heavy component of balance sheet equity, underpinned by assets and our stakes in our funds and our REITs, which we can further calibrate going forward. I touched on the strategic importance, we believe, of maintaining some of that headroom because it allows us to be nimble. It allows us to deploy that headroom when we find interesting opportunities, and some of these we hope will be fairly transformative or strategic in nature, and we can move very fast. If we have equity that we can further raise, if CLI stock is trading well as we believe it will be, then that brings in another interesting component, a component that we have not had for quite some time. So combining both of these things allows us to go out and deliver transformative growth to some of the questions that you have already raised earlier today. So I think that's something that's very important to acknowledge and remember. How that then translates into ROE is going to be a function of what that equity base looks like in 2 to 3 years' time. And secondly, our ability to execute. And if we find that we are having trouble deploying that equity base, then management will have to address or cross that bridge at that point in time. And there are options to do that, to engineer or deliver that baseline ROE. And the second more immediate point is obviously where we are in the recovery process. We were, unable to sustain our good financial performance in 2019 last year because of COVID. We hope and are encouraged that we are in the midst of a recovery process. How long this recovery is going to take for all businesses, CLI included, is going to be a function of our response to COVID as a global economy and our ability to pivot our business, deliver a good recurring, resilient fee income base, recycle that capital where we are able to deliver good portfolio gains. So that is the second more near-term driver of ROE, and that is partly due to us, but also very much reliant or contingent on how the global economy is going to perform in this recovery phase. I hope that addresses your question, Louis. I'll let Chee Koon talk about growth.
Louis, thanks. Good question. If you take a step back, you look at our track record in the PE space, I must say that our track record has been patchy. That's an area of focus that we really want to do, strengthening our team. But I would imagine that in the first few years when we set up more PE funds, we probably as an entity would have to allocate more capital to at least support it, to make sure that there's an alignment of interest between us and the LP that we are raising money from. So that's one area that we need to be prepared to apply our balance sheet. The other areas would be providing the balance sheet to acquire either new assets or platforms that we could create new REITs products, which we want to continue to do. The income from the REITs is an important one. I mean, we have today, as we speak, 6 REITs. I think there are other opportunities of REITs platform that we can create as well, and that's something that we are definitely looking to do. The third area would be in terms of platforms, be it lodging platforms, being other asset management platforms that we could potentially look at to acquire to complement us in certain asset classes that we may not have in certain markets that could allow us to essentially grow our asset management capabilities and allow us to raise money a lot more effectively, whether it's in terms of new products or new markets. So that would be how we would want to look at using our balance sheet. Of course, there could be other major M&As that we will be looking at. One important point to emphasize is having the ecosystem together with CLD. I think it gives us a lot of flexibility to look at M&A, where when you look at platforms, that could be asset managers, that could be developers, it could be have assets, and having a partner that you can work with, I think would allow us to very flexibly be able to see which pots of capital we can call on to make sure that we can truly maximize the firepower and the maximum returns to the various stakeholders.
Thank you, Louis. We'll take a question from one of our viewers on the webcast. It's Frederick from AIA. Frederick asks, could you provide more details on the expected leverage levels for CLI and CLD?
Thanks, Frederick. I can share with you what CLI will be on day one. So on a pro forma basis, taking into account transactions that we have announced here to date, the pro forma leverage is coming in at about 0.55 net debt to equity. So this is, again, I think as some of you have already reported this morning, substantially lower, almost a full one turn lower than where we are on CL's basis. Difficult to comment on where CLD will be, but I think I would say it's typical of a development business, residential development business. So for those of you who know us well from our development side, I think we should expect to see CLD run those types of development businesses. Well, I'll make one more point. I think our previous model was very balance sheet heavy, where we would take controlling stakes in most of our projects. And I think we've realized or believed that is no longer the case, where our development partners, our capital partners, trust us enough, where we are in a position to enter into JVs and partnerships with them, where we continue to be usually the largest shareholder, but we no longer need to take an economically dominant share, which allows us to deconsolidate many of these projects and maintain an efficient consolidated gearing level. So I think this again speaks to track record, speaks to capital efficiency and our ability to grow the business at a sensible clip, whilst not overburdening the consolidated balance sheet. Hope that answers your question.
Thank you. We'll go to Gula from The Edge. Gula, would you please unmute?
Yes, okay, so I'm student, yeah, so hi, hello. Yes, thanks Andrew and Chee Koon for the presentation earlier. So my question is, how will CLI change from the old CapitaLand as a sponsor for the REITs? Will it still be able to support the REITs during their equity, not just with their pipeline, but during their equity raisings? And will they retain their current reduced stakes in CLCT and CICT? And in addition to that, I think Louis was also trying to ask, will CLI be bypassed if the REITs take pipeline directly from the new CLD? Those are the questions. Thanks.
Gula, let me answer the questions. Thanks, good questions. The CLI, being a sponsor of the REITs, will definitely continue to want to make sure that the REITs do well. So the idea is that we will continue to provide the level of support. I think we have also publicly announced that our wish is that we will continue to hold a long-term stake in our various REITs platform to the range of between 20 to 25%. So it depends on various activities, but long-term, I think that's what we are looking at. Whether we'll review this target, I think it depends on the various how the various REITs are growing. If the REITs are indeed growing significantly bigger, I think we can review the stakes at a later stage as well. Your other questions are whether the CLI there's going to be a double handling from CLD to CLI before it goes into the REITs. My own view is that there's no need for double handling if the CLD can immediately inject the assets into the REITs. But I think a lot depends on the details of the specific transaction, whether there are joint venture agreements, that the asset has been developed on the CLD side. So there are specific level of details at the asset level, but by and large, I think we are not advocating that there's going to be double handling. If we can sell direct, we'll sell direct. I mean, if the transaction can be done directly, it will be done directly between CLD and the REITs vehicles.
May I just add to that on the first question, Gula? I think in terms of partnerships, if you go back to slide 22, where we have set out some of the recent transactions, I think you'll see that there is a good representation of transactions where we are partnered as sponsor to some of our REITs. Right? It started with Capital Spring, which again was a very good template to demonstrate the role of a responsible and supportive sponsor in helping the REIT digest a major redevelopment or a major acquisition. A more recent example is in the case of ART, where the Ascot or CL Lodging partnered ART in the acquisition of a PBSA development in the US. So again, that speaks to our support and continued commitment when a REIT identifies, one of our REITs identifies something that's interesting to them to deliver to their own unit holders, but are unable to digest it in one go. I think that is where CLI can step in again with this balance sheet that we have handy, dry powder that we have handy, to continue to support that organic growth of our REITs. A lot of this is also going to be tied up in the future in terms of redeveloping and renewing our REIT portfolios. Okay, for those of you who are based in Singapore and increasingly in China, you are starting to see this renewal theme starting to play out and become a major capital requirement. And for our older assets, where the REITs have identified and are looking to redevelop, rejuvenate, I think again this is where both sponsor and REIT can come in to play a role in renewing the current portfolio in the face of an important ability to repurpose and future-proof these assets in a post-COVID environment. Thanks.
Thank you, Gula. We'll jump to Xuan from Goldman Sachs.
Hi, morning, Andrew and Chikun. I have one question on margins, both for the fund management and lodging management business. So as mentioned earlier, 2020, there's a bit of anomaly. So how should we think about stabilized EBITDA margin and also the potential upside from operating leverage going forward?
Thanks. Xuan, I'll take the margin question. I might need a bit more clarification on operating leverage. But in terms of margins, again, on March 22, we set out a historical margin for the fund management business. I think 56% it was. I think you can sort of take that as something that we will aim to at least match going forward. For the lodging side of things, given where we are in the build-out and the scale of the business, I think previously shared that the margins are sort of north of 30% EBITDA margin. That is in line with actually many best-in-class operators today, those of who operate on a similar basis, very capital efficient, managing keys for other asset owners. But I think there is room to improve that even further along the lines where we are able to match the EBITDA margins or at least approach the EBITDA margins that we are currently achieving for our fund management platform. And that again comes from the lodging management's target to scale up, where we can then really start to realize the economies of scale from our platform, to digitalize the business so that we can further improve on cost synergies and to leverage the brand equity that we are increasingly building into the platform. So I think the lodging management EBITDA margin is on course to continue to grow as we scale up the business. and EBITDA margins for fund management along the lines of a 50% plus, as we have previously shared. Or that's a healthy margin. We will look to further improve that from improved FRE FUM going forward.
Shane, maybe I just add the part on the lodging operating leverage. I can share a bit more because I used to run the lodging business. If you trace back the history, I think I don't have the numbers offhand. Essentially the corporate headcount, both at the HQ level and the country level, have stayed relatively stable or even reduced over time because of the various initiatives that have been taken to digitize and digitalize the business. And the complementing with that discipline in terms of keeping the corporate costs, I would say, very low. The team has been able to grow the third-party management contracts quite aggressively in various key markets in China and in other parts of Asia. So you will see better margins flowing through, especially as you see the hospitality business recovering. I mean, in China today, the lodging business is actually doing very well, high occupancy. Of course, the ADR is not the same as before when you have a lot more international visitors. But I would say that the lodging business is quite well positioned to benefit when the industry recovers.
Thank you. And if I can follow up on the second question, also on EBITDA contribution as well. Currently, fund management, lodging management is about 20%. How would that be once lodging stabilize, and any target contribution within the next 3 to 5 years?
Again, it will depend on the way the business shapes itself going forward. Right? I think if we continue to maintain this sort of hybrid approach, where we believe that the benefits of recycling that capital into incubation pipeline FUM for our REITs and funds, then the EBITDA contributions from what is essentially a very stable recurring business on the fund management side will approximate 20 to 30% thereabouts lah. If you assume that the lodging business starts to deliver its normalized share, and as we scale up to 120,000 keys or 160,000 keys, once we stabilize that part of the business, then you start to see a more meaningful contribution coming in from lodging management. But it will, I think, very much depend on where we sit on terms of the other side of the business. Where the long run stakes in our funds and our REITs are, I think we touched on the ability to further recalibrate that naturally over time. And then what we do with this remaining NAV that is on the CLI balance sheet, what is the strategic value to us, how we execute on that strategic value, and what we do as a result of that. That will determine the overall contribution split. And I appreciate that depending on the type of REIM we end up transforming ourselves into, then the EBITDA contribution on an overall basis can be very different. But as of this time, I think we are happy to see this shape come out of the gate for CLI because we believe it has strategic value, and we believe it gives us many strategic options in how we deploy that balance sheet.
Okay, thank you, Shen. We target to conclude the call at about 10:30, so we'll try to clear all the raised hands now. May we have Joy Wang from HSBC next, please?
Hey, morning, Chee Koon, Andrew. Thank you for the presentation. 2 questions from me. One is just to follow up on Shen's question on business split. If we look at how this business is going to shift, do we expect the sort of incubation all going into sort of brownfield assets instead of more greenfield, and therefore to keep your sort of EBITDA split between 20 to 30% from fees and the rest from investment properties? And also on top of that, in terms of the fee split, how do you think that will shift going forward in terms of fees from funds, fees from your lodging business, as well as property management?
Thanks, Joy. First question, around where the fees are going to come from, I think it goes back to a function of time. And I believe that for us to consider putting capital on balance sheet, it will be with the ultimate goal of converting that into FUM, right? That's the purpose of an REIM. So we will make a call. There is support needed by one of our REITs and our funds for us to co-invest, as we touched on in the previous question. Yes, okay, we might want to come in and help them digest something that is very interesting to the REIT and fund. So that's a role that I think we can play and we should play. Then the second is alongside whether it's green or brown. I don't think we are necessarily wedded to whether it's green or brown, but I think the key will be the discipline around when that capital gets recycled. What we don't want to have is the requirement for patient capital, which is the euphemistic term that we have applied to what is required on the CLD side of things, where the nature of the investment, green or brown, is long-term in nature. And that limits our ability to demonstrate return for investors. And as a result of the ability to demonstrate return, as attractive as that eventual return may be, then the market assigns a haircut to the value of that investment, which is what we have seen in the last 10 years. So I think for us, the point of decision is how long is this capital going to have to sit on the CLI balance sheet? If we decide that this is interesting investment, we should make this investment, then it's a question of time. If it's a 2 to 3 year investment, we believe we can monetize and convert that into FUM, or our REIT and our fund is coming alongside and will take the remaining amount, as we saw in investments such as Rock Square and so on and so forth. Then I think that visibility, that confidence to be able to take that position is much higher. And if we can demonstrate that track record of capital recycling within 12 to 36 months, let's say, then the market will also then have that confidence in the management team to say that if we make an investment, like we saw in our Minhang DC today, right? This is an on-balance sheet investment. Now, what we are saying implicitly is we're standing behind the investment is that we have a confidence to convert that into FUM in the not too distant future. If this sits on balance sheet for anything more than 3 years, then I think you are right in raising questions as to why did you guys put this on your balance sheet in the first place. This is patient capital. It's not capital that can be converted into FUM in short order and generate FRE, for which we want that multiple from the market. So I think that's the decision point. What's your second question? Sorry, I think I'm going to have a harder time answering that one.
Yeah. So second question is more on just balance sheet. How would you look at your balance sheet going forward? One is on the see-through level. Are you happy to disclose where your see-through leverage is? And are you going to manage from a see-through basis, or are you going to look at more from the group perspective?
See-through in CLI terms or CLD terms?
CLI.
CLI, our see-through is 0.55 on a pro forma basis. I think that gives us immediate headroom if we are running 0.6 to 0.7 as a sweet spot. I appreciate and acknowledge that many REIMs run typically low net debt to equities. We'll see again how the business takes shape. If we are talking about substantial on-balance sheet incubation because we are investing on balance sheet for the right reasons, as I mentioned earlier, then I think by translation and by design, then the net debt to equity will start to sort of stay within this range, because on-balance sheet investments typically require a heavier dose of debt. If our REITs and our funds are deconsolidated and are making investments and we are supporting them, then I think that can be much more nimble, much more in support of our deconsolidated vehicles, which allows us to manage that net debt to equity much more nimbly, perhaps much more in keeping with how some of the other very capital-light REIMs are able to do so. So let's see how the business evolves over time. I go back to the strategic optionality that we've built into CLI from day one. I think we firmly believe that is a strategic asset rather than something that we need to manage or address as an issue.
Right. So is it fair to say that you haven't set like an internal target where you want to get to in the next 2 to 3 years?
In terms of NDE?
Yeah.
No, we haven't. We want to allow ourselves this ability to look at our strategic options, scan the universe, see what is out there, if there is a transformative M&A opportunity that requires a good dose of equity and debt, obviously the idea is that we have both at our disposal, then again, a strategic option is in play that perhaps was not available to us or is not available to us today. So I think that has good value, and based on some of the questions we're getting from you guys, I also believe that you believe that has good strategic value attached to it.
Thank you.
Thanks.
Thank you, Joy. We will have Donald Chua from Bank of America next. Donald, please.
Hi, Andrew. Hi, Chikun. Sorry, my camera is not working. Just a couple of follow-up questions, please. First is on your fee breakdown you mentioned earlier. So 21% of the EBITDA comes from fees. So going forward, can we assume that CLI will stay at the EPRA FTSE Narita index, and going forward you are prepared to move out the index if the fees goes up to more than 25%? That's the first question. Yeah, the answer is yes to both questions, Donald. Okay, thanks. Second is quickly on the margins as well. The lodging business has been mentioned, but what about the property management fee margin, and how meaningful is the EBITDA from property fee margin? I think you mentioned it's a cost plus basis, right? Yeah, I think that's also fair, Donald. We have not emphasized the PM. It is a supporting business at this point in time to our asset base, 330 or so properties within the asset management platform. It is essentially cost plus, so it does earn a positive margin. The margin is not something that I would say you should assign a great deal of value to, but it's something that is positive nonetheless, and I should add is very capital efficient because there's no capital assigned to it. It's just investment in people and the operating platform per se. So while the margins may not jump out of the page, it is actually quite an ROE accretive business because it involves very little capital. And our view on PM at this point in time is it serves to enhance the overall operating performance, particularly for our high-touch assets, where retail, in some cases lodging, require a very finely tuned, very experienced PM side of the business. Whether it has strategic growth for us is something that, again, we have looked at and continue to look at going forward. Thank you, I understand. And also on follow-up on the assets that the REITs will be acquired or could acquire from CLD. What if those assets are also ROFRs to CLI? Then what would be the arrangement? You're saying that a CLD asset that has ROFR to CLI. Oh, that ROFR allows us to allow for any of our current platforms to acquire it. Yeah. I understand. Okay. Yeah. And my last question, is that do you expect any promos or performance fees coming through from your private equity funds in the next few years?
I think it really depends on how well we execute on the deals. I mean, the important thing for us is to make sure that we deliver returns above the hurdle. I mean, of course, if we can do that, then of course the promote will flow through quite nicely, and that will drive the upside to the fee income, which I believe some of you earlier alluded to in terms of especially in terms of the contribution from in terms of fee to our private equity business, and that's definitely an area where we are spending a lot more time and focus and make sure that we behave and execute truly as an asset manager. Will you disclose the hurdle rates going forward for the promotes? I think a lot of the funds have different confidentiality agreements where most likely not, but we can probably give a range rather than to give specific details to funds, because fund investors, they do have different requirements in terms of confidentiality. Understand. Thank you. That's all from me.
Okay, thanks, Donald. We'll take questions from Morgan Stanley and UBS before we conclude the call. So may we have Wilson from Morgan Stanley first?
Hi, morning, Chikun and Andrew. Can you hear me?
Yes.
Hi. Yeah, just a few questions from me. Maybe firstly on the investment properties. on balance sheet at $10 billion. So I understand you're looking to sell it down in 3 years, but also there is some form of replenishment through a pipeline of investment properties that could be then monetized through the REIT or fund platforms. So is that how we should be thinking of it, as a pool of $10 billion of assets, which will be constantly replenished and churned about 1/3 a year? Is that how we should be thinking about it?
Thanks, Wilson. Okay, so going back again to the strategic options that we have, that is one way to do it, right? If we choose to keep the structure of CLI the way it is on day one, where we want to continue to have this platform, because we believe that having that headroom that is generated by this NAV on balance sheet is useful to us. That's one way to go. The other way to go is to become extremely equity-light, where we sell down our 10 billion or so REAUM and we don't replenish. And then the equity base shrinks through a return of capital or through a reshaping of our stakes in our REITs and funds or some combination thereof. And then that starts to resemble something more like along the lines of a pure play REIM. So I'm sorry, I can't give you a more definitive answer, but at the same time, I do believe that this represents strategic optionality for us. And depending on which way the market perhaps may drop some hints in the months and years ahead, I believe that if you are talking about a extended recovery phase where you want to have different buttons you can press in order to continue to grow the business, then it actually, I believe, makes sense to have this pipeline that you can replenish, because you can then continue to demonstrate that growth and FUM. One of the observations we have made as a senior team is that there's a lot of capital out there looking to deploy, and this capital is chasing a very finite number of assets. So if you have assets, or you have the ability to acquire assets because we have presence on the ground in our core markets, we have good relationships, we have a good ecosystem partner that can come in alongside us, then it may make sense to continue this, to generate this pipeline, because other REIMs may not have that ability. They have to move much more quickly in order to secure an asset, because they don't have the ability to warehouse, to incubate, to put in play something that then represents future FUM on a very near-term basis that we can demonstrate to investors. So it very much depends on what I think emerges in the next 12 to 18 months and what gives us the best sense of how we should take the business going forward. The key, again, is that we have this option. And options, in my view, are valuable. But of course, you have to act on the option, demonstrate that you have added value as a result of exercising that option. Otherwise, that option has no value to us, and we should eliminate that option and go with something else.
All right, thanks, Andrew. Just last two questions. So just follow up on Donald's question. I think I missed that earlier. Did you say that you're expecting CLI to stay on the FTSE Primary Index?
Yes. On day one, yes. And then again, it will be contingent on what proportion of fee income and so on emerges from the business. So to your first question, that will be a function of where we go, right? But as we are saying, we are prepared to have ourselves be removed from that index if we choose to take CLI in that direction to become a much more pure play REIM.
Got it. Thank you. Just one last question. I think it was brought up earlier also on the private equity fund side, the IRR hurdles to trigger those promotes. Or maybe could you share, like, historically, what are kind of IRRs achieved at the private equity fund side, or historically, what were the hurdles that were set?
Quite hard, Lawis. This is also, again, very proprietary. LPs are sensitive to that. I would say we can do better in the way we have entered into previous agreements. The way we structure promote into our fund product going forward is going to change, and we are looking to do that. We've already started to do that. And so while I would ask you to not allow us or not have us share the actual numbers, in principle, what I can share with you is that the nature of the product is going to include more promote going forward, and our ability to earn that promote is going to be a function of our private equity execution. Both of these points, I think, are different from our previous approach to private equity. So on a principal basis, on a directional basis, I think that is an important change to note. whilst I'm being unable to share the specific numbers. But you should then, over time, start to see that get translated into the fee income contribution from the investment fund side of things, right? Where you can then sort of see what's the recurring base, and you can see what is the one-off contribution, which we will be able to sort of share with you on a qualitative basis. The idea is that increasingly, in addition to the REITs, we will start to see PE side of promotes contributions start to be included in that, which should then start to see margin contribution expansion going forward for the fee income business.
Thank you.
Thanks, Wilson.
Thank you, Wilson. We'll take final questions from Michael, UBS. Michael, please.
Hi. Good morning, Chee Koon and Andrew. Can you guys hear me?
Yes.
Great. So I've got one question. I'll keep it brief. I was just looking at the P&L, and on the administrative costs, about 2/3 seem to have accrued to CLI. So can you give us a sense of, in terms of the direct headcount, how many CapitaLand had before, how many is on CLI now, and then in terms of the cost sharing going ahead, how should we think about that?
Okay, thanks, Michael.
Why don't we get back to him?
Obviously, and on a left field question. I can share with you what I have off the top of my head, and then we'll come back to you offline on a more specific answer. The reason for the heavier admin split is simply because the operating platforms are coming to CLI. And so most of that is staff costs, staff-related costs, for which we have to bring over to CLI because most of the operating platform is coming across CLI. That's the simple answer. So nothing too earth-shattering behind that. Was there a second part of that?
In terms of direct headcount, if you got any sense of CapitaLand and then what is coming over to CLI now and how the costs are going to be split ahead.
Out of 14. Okay, there'll be roughly about 10,000 CapitaLand staff comprising obviously our IAM teams, but most of that will be the operating platforms coming over to CLI.
But those are at the property level. Yeah.
Okay, if we just strip out the people from Ascot, because and all the hospitality part, so just the direct headcount on CapitaLand in terms of management, I think I just want to get a sense of that. But you can come back to me later if you've got specific numbers.
Yeah, Michael, we'll come back to you later. Thanks.
Okay, thank you, Michael. And with that, we will close the Q&A session. I would like to thank the media as well as our analysts for the thoughtful question. I will hand over the time to Chee Koon for concluding remarks.
Just to thank you for making time this morning. This is, again, a major undertaking by the management team with the very strong support from our board in positioning the company for the future. We really look forward to your support at the EGM, at the coming EGM, so that we can get the necessary approval for this restructuring to be done, and then we can focus for the next phase of growth for the newly listed CLI. Thank you.
Thank you, Chee Koon. Before we end the session, I would like to make a final call to all our shareholders to visit our shareholder meetings platform. The meeting platform has all the resources to help you make an informed decision. Also, electronic options to submit your proxy forms are conveniently placed there for you. We look forward to your support at the meetings, and thank you for joining us. Have a good week ahead.